look also at the Modigliani case study, and we will go to that in a minute. So what I would like ideally to do today is to discuss pharma, maybe Modigliani, and of course go back to Modigliani-Miller and capital asset pricing model. Okay, so I want to to go on with that so that after 4 sessions, that is half of the course, you have all the tools so that you will be able to work out the case study you have to do, or not everything of the case study, but at least the first part of the case study. And in order to help you, I will give also some exercises with solutions. Of course, next time, Monday, you can ask me any question about those exercises and solutions. I won't go into them in detail, but I will upload all that. So tonight, I will upload solutions of the case study. I will upload exercises, answers, either tonight or tomorrow. Okay? So I want to finish all those important things that we are saying about, capital asset pricing model, using corporate finance, Modigliani-Miller. All this is really important for you to really master, have in mind. And the real good way to master that is really to go through some kind of case study where you are in a world that is easy, but you'll see that what's important is the logic of all that. Just to tell you that, incidentally, yesterday I was with a friend, who is a professor at HEC and also investment banker, so he's affiliate professor, and he's really extremely good in valuation, things like that. And we interact a lot together. And he always tell me, what you're doing is so important. I mean, people do not master that. They do not understand that well. It's really important. Even at HEC, there's only one guy that I know who is doing that. And it's very important for executive and for students also, to really learn well about all that. It's really extremely helpful. And we did some defense on capital budgeting case studies, valuation model yesterday. Each time we get along extremely well when we discuss those issues. So do not have the feeling that what we do is something that's more related to theory and not useful for the real world. What I'm telling you is that what I'm teaching you today are things that are not that easy, that you have to train, that you have to think about, that you have to train with exercises, case studies that you will have to do, so that you improve on the way you're able to think about all that. So I always remember where I am, and so we were discussing about valuation models, and what we said about valuation model is that there's convergence of valuation model, which is extremely important. Yesterday I've been doing with an investment banker valuation, so obviously we know there are many methods to value a company, but those valuation models, what's important is to know that they should converge. So if you really find very different value using different methods, then you should be a little bit afraid that things are not completely in line, that your models are not completely in line with each other. Okay, so that's what you have to have in mind. So I think we were doing that. I think we were on this slide. Okay, and I think that we already did a lot of things. So I said, no, I want to keep that for next time so that we don't hurry too much, because it's important. I cannot remember if we did this slide or not, but it's not a big deal. If we redo it, so if you take, let's take for instance, so you take the value of equity and you use a dividend. You use the dividend discount model. So I hope I can write not too badly here, because I'm standing. It's not really optimal. Things are a little bit stupid. I cannot sit. But anyway, so the value is like that. So now imagine that you call P the payout. P is the level of payout of the net earnings, and K is the cost of equity, and G is a constant growth of earnings to infinity, then you know that the Gordon growth model tells you that you can write P, okay, then let's call that like that, okay, so this would be, sorry, B1, okay, so B1 is like the earning, the profit, okay, I call that like that, so that's the net earnings, okay, so B1 is the net expected earnings over K minus G. Okay, so I can write down using, so there I'm using a dividend discount model. Okay, and this dividend discount model, of course, it's easy. I think we did it last time. I cannot remember. But if you take this B1 here and you have the B1 here, what you have is that E over B1, okay, is going to be the price earning ratio. And the price earning ratio, what it tells you is what you have behind the multiple. Okay, so behind the multiple, what you have is payout. Okay, so everything else equal. Okay, all else being equal, which is important. Okay, the price earning ratio will increase with P. Okay, second, it will decrease with K, and K depends on the underlying operating risk of the company and the level of leverage. Okay, so level of leverage will increase the level of risk, as we will see in a minute, and so it will depend on the operating risk and the level of debt. And we know that what's important is, of course, the systematic component of the risk, which is taken into account in the discount factor. And it depends also on the expected growth rate, J. Of course, if you look at this here, you may tend to think that, well, if you increase P, okay, so if my firm increase the payout, okay, if your firm increase the payout, then the P will increase. But no, it's not like that, because generally, okay, what will happen is that if you increase the P, okay, if you pay out more money to shareholders, then you have less money to reinvest, and you will decrease J, okay? And what Miller and Modigliani will tell you is that, well, you know, the increase in P, okay, will be like there is a decrease in G so that the P is equal. Okay, so this is Miller and Modigliani on the dividend policy. Okay, so if you increase the payout, then everything else equal. That is to say, if you don't change the future cash flow of the firm, if the firm has the same level of risk, so the fact of paying out more dividend will not have a positive effect on the stock valuation. All right, and I think we did it, but I may want to do it another time so that you really have this in mind. Okay, so imagine now I'm talking of the firm valuation. Okay, so I'm discussing about the enterprise value. So if you have V, so V is the sum of free cash flow discounted to K. And okay, let's imagine that the free cash flow is growing at K minus G. Okay, so J, is the growth rate of the free cash flow. So again, I think we did it last time, but what you have is that the value of the firm divided by the free cash flow is 1 minus 1 divided by K minus J. Okay, and what is that? This is a multiple. Okay, this is the firm value divided by the expected free cash flow. So it's not exactly a V divided by EBITDA, but you know, it's like correlated to that. And so what's important to see is that if you take the firm value, okay, the firm value will the multiple, the number of times you pay the free cash flow when you assess the value of the company. Okay, it will of course decrease with the cost of capital and increase with the expected growth rate of the cash flow. Okay, so please keep that in mind. That's very important. So how do you explain a certain level of multiple? There's always something related to the risk. Okay, and there is something related to the expected growth rate. And if I recall you something also, remember we did that last time. I can remember that. If you take a dividend discount model, okay, so if you take a dividend discount model, or if you take a DCF, okay, discounted cash flow model, okay, the difference is that the J year and the J year would be different, okay? Because when you do a DCF, okay, you do as if all the free cash flow is paid out, okay? As if the free cash flow is paid out. Whereas when you take a dividend discount model, okay, you take into account the payout policy of the firm, okay? So the J here will be higher than the J that you have here. So watch that, be careful. As I told you, there are mistakes on that, and people are not very careful, and they tend to use the same J, which is completely stupid, because they forget, okay, that doing a DCF, using a valuation model like that, is considering that each period, all the money left on the operating cash flow when you've paid your capex is paid out outside the firm. So please keep that correctly in mind. So I think we didn't do it again. Unmute your microphone. Tell me, no, we did it already. And yeah, I hope it's registered. I think someone took care of that, because I know it's important for you. Hold a second. It should be okay. I will check after. Okay, so I want to go on like that. Okay, so if I use that, and you see that in case studies we will do Modigliani, in the Modigliani case study, there is things related to that are important. Okay, so think about that. How do we use, so I'm going to illustrate this, okay, and then I'm going to illustrate that. And these are really warnings that I'm going to really emphasize here. So let's open up a white page and say something. So imagine that you have a stock price of 100, okay, and imagine that the profit, okay, this is the net, let's call it like that, it'll be more in line. The earning per share, okay, is 10. So you have a stock, value 100, earning per share 10. Of course, PE is 10. And what are analysts doing? So if I am a financial analyst and I'm looking at stocks, okay, so I'm an equity analyst and I try to anticipate some variation on the stock price, I may be interested, and we know that many financial analysts are very interested in changes in earning per share. So what you are interested in is look for revised, okay, earning per share. And imagine that you expect a revision of the earning per share of 1. Okay, so your earning per share jumps from 10 to 11. And as an analyst, what I do is I think hard about events, okay, that may have an impact on the earning per share. And now what I may do, as many do, if you are interested in that, and you say, well, what would be the impact on the stock price of this earning per share revision? In a certain sense, what you do is you are considering that the level of PE is unchanged. So you consider that the PE is unchanged, and so from this revision of 1, you infer that the stock price will be 1 or 10. Okay, so here, what you have here is, I'm going to call it C0 revised, which is better. Okay, so you expect revision, you try to anticipate revision on earning per share so that you have a revision of the stock price. Now let's think about some stories, just to think hard a little bit about what we are doing here. Imagine that at the beginning, okay, the firm has cash. Okay, so this is the operating value of the company, and the firm is not leveraged. Okay, so you have no leverage, just to simplify. And imagine that the firm is using part of the cash here, okay, and the company is doing that to buy back stocks. So you go on the market and you buy back stocks. So you have N stocks and you buy small N stocks. What will happen? What will happen is that the earning per share, okay, the earning per share that you will have will drop, will increase. Okay, and why is it that the earning per share revised will increase? So this one, the earning per share will be higher than the earning per share one. And why is it that this earning per share will increase? Well, the earning per share will increase just because the number of shares is going down. So if you look at your earning per share, so the earning per share revised would be the net earnings of the firm minus the interest that you received, minus the financial product that you have, minus the interest received after tax. Of course, you had some tax on that, okay, and then you divide by n minus n. And the fact here is that it's cash and it's it provide RF as an interest payment, and the fact that here you buy back shares that the required rate of return is KE makes the earning per share increase. It's mechanical, so it will increase. Okay, now my question is the following. My question is the following. Question is, imagine that I have some cash, buy back, use this cash to buy back some share. Earning per share is increasing. Okay, and earning per share is increasing from 10 to 11. So this is the trigger of this change in earning per share. Question, shall I expect an increase in the stock price? So what's the answer? Well, I'm gonna, I'm not connected, so I don't want to lose this page. Okay, so I'm connected to the internet. So maybe I can just use 2 minutes, just so that I will have the chat. See if it works now. Should be able to work. Okay, so what do you think? You can unmute your microphone. Otherwise, I'm going to provide the answer because I don't want to lose too much time. Excellent, it's working. So I'm going to have two computers. Okay. Okay. Perfect. Excellent. So I'm gonna be connected twice. It's great. With Canvas, you can connect with two computers. Okay, let's see. So I can see now the chat so that I know you don't like to speak up. Oh, and I can see. Oh, so I have to stop this. Okay. Oh, okay. No, so now, no, stock price will increase. Aha, no, I disagree. So Trim, thanks for saying that. So I can see you now, it's perfect. Okay, you can see me. Yeah, you can see me, you can see my board. And I can see my own board, so I can see what you see. So it's okay. Life is nearly great. Okay, except that I'm standing, so I have to look for a high share. Okay, so yeah, why no change? Yeah, why no change? Because okay, is what we said. So please So you have to. So of course, what we said at the beginning is that so imagine that you are here the K, the cost of capital of the operations here, and here you have RF, okay, and here you have KE. So KE is the cost of equity of the firm, where the firm is composed of the operating asset and the cash. Okay? Imagine a firm has cash, the cash is in the value of the equity. Okay? But what will happen with the cost of equity? I know that it's important to repeat. Okay? Back to Tobin. Okay, so this is Tobin 1952. So that's not yesterday. And what we have here is you have here the operating value of the firm. You have the operating risk. Okay, here you have the cost of capital operating, that is to say the required rate of return on your operating asset, and then you have your risk-free rate. Okay, and the firm is somewhere here. So this is the equity. Okay, so what will happen is that the fact that you have some cash is having a negative effect on the return. Okay, so KE will be below the K operating, but what will be below also the K operating? So this will be the volatility of the equity, and what we have is the volatility of the equity will be the volatility of operating asset. Okay, so what will happen is that if the firm has cash, buy back shares, then the cost of course, the cost of equity will decline. So here I may have 10% cost of capital and my return for my shareholder is 8%. Yes, but the risk is declining. And the idea is that if I look at that or if I look at that, okay, it's the same. It's not the same as this is a different return and a different risk, but it means that if you go from that to that, okay, you change the return, you change the risk, but it does not create value. The sole thing that you do is remove some cash that was lowering the return, that was lowering the level of risk. Okay, so let's go now to the story. You have here a relative. Okay, so if you buy back share, when you buy back share, earning per share is increasing. Okay, if I'm a financial analyst and I use this revised earning per share and I consider that the stock price is increasing, what I consider is that buyback per se has an effect on the stock price, that the stock price is increasing. But that's wrong. That's wrong. That's wrong because, in fact, what's the mistake that we do here? The mistake that we do here is that we don't understand that P is declining. In fact, if you look at the slide that you have, okay, is you have this. Okay, so what will happen? What will happen at the minimum? What will happen if you buy back the shares? Okay, what will happen at the minimum is that K will increase. Okay, what we know is that if we buy back shares, okay, so if you buy back shares, you do that. If you do a buyback, you go this direction. Okay, that is to say, imagine that I buy back everything. Okay, let's do it like that. If you buy back everything, it means that you don't have this cash anymore, and what will happen is your K operating will be the KE. So K will increase. Okay, K will increase, the risk will increase, and K will increase. But K is also the cost of equity, and the cost of equity. So the expected return will increase, and the cost of equity will increase. But this increase in the cost of equity is associated with an increase in risk, because cash is lowering the variation on the value of the operating asset. So see that earning per share here is totally useless. Okay, if you look at earning per share is increasing, but you have to think about what happened to PE. And what's happening for PE is that, well, PE will go down. And why is it that it will go down? Because the risk is increasing for shareholders. Okay, so this is exactly where we are. If you buy back, your risk is not sigma E anymore, but it's sigma operating. Okay, and your required rate of return is not Ke anymore, but it's K operating. So it means that your P will decrease, because the required rate of return of shareholders will increase. So that's here one example that each time you work out with a multiple, you're compelled to think about, does this multiple change? Okay, if you use a multiple, if you look at an earning, if you look at the free cash flow, and there is a change, but there is an event that triggers a change in earning or in the free cash flow, the idea is that is the underlying fundamental behind what you have behind the multiple is changing or not. I'm going to tell you another story. There is too many things. Maybe I can use this here. Okay, so if there is no question, you can value of number of change, price of change. No. Price of change is not increasing. So what I'm saying here, okay, what I'm saying here is C0 revised is equal to C0, and it's going to be earning per share revised multiplied by P, but P is revised and is revised down. So this is increasing, but this is decreasing. And why this is decreasing? Because risk is going up. So K is going up. Okay, and behind the multiple, what you have is the level of risk. Okay, and the level of growth. I tell you, so this is the first story. Second story. Imagine that the company, has now an expected revision in earning per share. Imagine that that's an electric automotive company. Okay, so you are a company building electric cars. Okay, so you are a company and you build electric cars. You are Tesla, a couple of years ago. And imagine that, your company is not going extremely well, okay, and suddenly, okay, you say, things are moving. The demand for electric car is coming, and then, earning per share will be higher. So there is positive revision in earning per share. Okay? Then, what you may say is that, okay, so my earning per share is moving from 10 to 11, so this will trigger an increase in the stock price, and my stock price will be 110. Think about the story I say. I say, I am Tesla. I'm saying that, people are getting interested in electric cars, and the demand is higher, the turnover will be higher, and this year the company will be making a higher profit. Okay? And so my question is, is that correct to state that the stock price will increase from 100 to 110? That's the question. So what do you think about that? Given the story I said, think about what you have behind a multiple. Think about what you have behind a multiple. Okay, a multiple is P K minus J. Think about that. Okay, and this is equal to 10 in my case. Okay, P of my company here is 10. You have a P of 10. And so I say things are going better. I sell more electric car. I will make a higher earning this year. So I end up having I will have a higher earning. So I end up having a stock price higher of 10%. That's not consistent. That's not consistent with the story, because what you say in your story is that this is changing. You are not only saying that things will be better this year. You are saying that people are becoming interested in electric cars. There is a demand growing for electric cars. So in a certain sense, what you have is not only that this year is going better, but that the profile of growth of earning is different. What you are saying here, okay, what you are too bad. Not worry. I'm gonna state it again. That's important. Huh? That's important, and I'm gonna state it again quickly. Okay? What I'm just saying here with this case, okay, if you have earning per share of 10 and becomes earning per share 11, okay, and you are saying I am an electric car, and here my P is 10, so my stock price is 100, and then you say the stock price revised is 110 because the P has been increasing, because the earning per share has been increasing. What you say is you keep that constant. But this is wrong. This is wrong because what you are really saying here is I am doing better. This is changing. And what I wanted to draw is this, is that what you're saying is that maybe this was the trend of growth of your earning per share, and what you have now is that, you know, those earnings are picking up more quickly. Okay, that's what you're saying. What you're saying is not only that, you know, things are better this year. Okay, you are not saying, sorry, this is your earning per share. Okay, and this is the earning per share revised. Okay, and what you're saying is not only that the earning per share of first year, so this would be the first year earning per share is increasing. Okay, it's not only, but what you're saying is that the growth rate is changing. So if the growth rate is changing, it means that the P is increasing. So if you say that the stock price is 110, you underestimate the effect of your information on the stock price. So see that very important to always have in mind that behind a multiple, you do have fundamental value, okay? And if you recall what we said in the first session, what was forgotten in the case of the Carrefour case study, okay, when you were doing a sell and lease back of the real estate, what was forgotten, okay, is exactly that. Okay, is that you had a company, the company had some real estate and it was doing some retail. If you remove the real estate, okay, and you say the multiple is 12 and here multiple is 7, okay, so you say, okay, your company today with both multiple is 7, you remove the real estate, multiple is 12. What will happen is, why is it that the multiple is 12? Well, just because the risk is lower. Because here you have a lower risk, then your retail activity has more risk than the real estate. So what will happen if you remove that is that the multiple, sorry, we did that already, will decrease because the risk is increasing. Okay, so assessing what will happen using multiple when you break up assets of a company, not taking into account the effect of what you do on the risk and the growth is stupid and leads to poor analysis of what will happen on the firm valuation. And obviously, this was the Carrefour case study I say in introduction, but the idea is that if you consider this case study, okay, it's a major company. It was the second retailer in the world. Many financial analysts were saying stupid things just because they don't understand that behind a multiple you have that. And who is right? The market. And what is the market doing? What I'm telling you. Okay? That is to say, even if many people are using multiple and making mistakes, okay, using those multiple, not understanding the underlying things that you have behind multiple and making financial operation leads to stupid decision and doesn't lead to any value creation. Because at the end of the day, some people on the market are smart. some people understand that, okay? And even if those people are not the people that are speaking up, okay, they end up having the right valuation on the market, okay? So please keep that in mind. Okay, the second point I want to highlight, which is important, okay, is this one. I'm not sure I didn't do it already. I can maybe forget, but that's not very important. If I do it, I have the feeling I told you that already. Anyway, it's my fault if it's the case. So imagine that you are a company 5, okay, and you are using a company 1, 2, 3, and 4 to value company 5. And you want to use multiple. Okay, what you do here, imagine that the P of company 1, 2, 3, 4, 5, so I'm not giving you the figures, but I say 10. Okay, here is 8, and here is 6. Okay, and if I sum up all that, okay, if I sum up all that, it's gonna turn to, let's do something more simple than that. Okay, I'm gonna do 14, 12, okay, so it's gonna be 10. Okay, so I'm gonna say that the average P of the industry. So I'm looking at the sport industry. I'm looking, sport, firms doing some sport equipment, and I'm saying, well, if I look at those companies, the average P in the industry is 10. And so, I could say, well, I'm gonna value the stock of this company. I'm gonna use the earning per share expected for company 5 and use the 10 to value the stock price of this company. So think about what you do when you do that. Again, what I'm leading you to do is try to have some critical thinking about all that. This is something done all the time. Many people tend to do that. Use multiple, compute some average multiple, say it's the multiple of the industry, and then they do valuation. Now I want you to think about what you do when you do that. In fact, what are the underlying hypotheses? What do you need to do? What are the hypotheses? Okay, what are the hypotheses for you to value a company using comparables? When you use comparables, okay, so you use the value of other companies on the market, there are two hypotheses. Okay, the first hypothesis is that 1, 2, 3, 4 are correctly valued. Okay, if you believe that the market is not correctly valuing those companies, or one of those companies is undervalued, overvalued for some reason, okay, that you may tend to think that there is not enough stocks that are bought and sold, and there's not enough liquidity, and all this may weigh on the correct valuation, forget about the stock. Second hypothesis that you make is that 1 compares to 5, 2 compares to 5, 3 compares to 5, and 4 compares to 5. So when you do comparable analysis, okay, well, it means that the fundamental of the firm 5 is consistent with 1, with 2, with 3, and with 4. And now, and I have the feeling I did that already, but it's not a problem if we've been spending some time because it's so important. The problem here is when you look at the market, okay? So what is the market telling you? You are interested in the market because you consider that firms are correctly valued. And when you look at the market, what the market is telling you is that all those firms are different. Okay, so all those firms are completely different. So if those firms here are different, it's impossible that one is comparable to 5, 2 is comparable to 5, 3 is comparable and comparable if they all differ. Okay, so what does it mean? What I'm saying here is that doing an average or a median of all that is useless this figure has no value. Of course, if you had like 10, 11, 9.5, 10.5, etc., and you say, well, on average it's 10, I will agree. But if you have differences like that, or even more minor differences, will be a problem. Okay? So be careful. Always remember that behind the multiple, you have some fundamental. Okay? And the reason here is 6 and here 14 is maybe that the growth rate is very different, or maybe that the leverage is very different. Maybe the firm one has 0 leverage. So this firm here, 1, the debt of 1 is 0, whereas D4 is very high. So if you have a lot of debt, you have a lot of financial risk, and KE is very high. Okay? And if KE is very high, PE, so here, if you have a very high leverage, you will have a KE which is very high, and your PE will be down. Okay, so please remember that. You will see that in the case study I will give you, you haven't chosen yet this case study, still have to work a little bit out on it, but there will be things that you have to use, capital asset pricing model, Modigliani Miller, correct reasoning to assess the valuation of firm, and then, you will look at the impact on multiple and avoid mistake and really see what's going on. Okay, so what I'm going to do now is I'm going to correct. We will look at the answers. I think you can still see me. Okay, so what I will do now, if there are no questions, I'm looking at the chat. Okay, what I will do now, I check it's recorded, perfect. Okay, so what I will do now is I will go on the pharma case study. I will upload the case tonight, or maybe could have uploaded the case maybe. No, it's gonna be long. Is that complicated to upload here? Hold a second. Maybe I'm gonna upload the case now. Let's upload the case now if I remember how we do that. No, I think I'm going to do that afterwards, but because I think I need to get out of here. Okay, I will upload them tonight. I think that you can follow, even if you don't have it. I will be slow enough, and you will have them. So remember, pharma case study. Pharma case study. So we've been discussing that. Okay, so remember, it was about using the risk and return and capital asset pricing model to say whether a stock was correctly valued or not. So I'm going to open a slide here, make sure that I don't lose things, so that we can always refer to that. So now, if we recall quickly the case study, so this is pharma number 3, and pharma number 3 is a couple of pages after. In the handout, it is, in the main handout, it's a little bit afterwards. I don't have the page, but easy to find. So let's do the case together. And this case is really important because what we will learn here, and make sure that we understand well, is we are going to discuss about leverage. We are going to discuss about the effect of debt on firm valuation. Okay? And in order to do that, we will not use Modigliani Miller, but we will use capital asset pricing model. That is to say, we know we know how to use capital asset pricing model, and what we will be doing is using capital asset pricing model, leveraging the company, and look at how it affects the cost of equity, how it affects the cost of capital, firm valuation, the equity value, the stock price, the blah blah, etc., beta, etc. So I recall you that the company is like that, so I'm able to recall that. So we will always keep this slide. So we have the pharma, so the value of pharma is like that, and the equity of pharma. And the firm is unleveraged. And the firm is worth 1 billion, 1 billion. And I recall you that the cost of capital of the firm is 9%, but the cost of capital is also the cost of equity because there is no debt, and the return that you may get is 12, 9, and 6, and on average 9%. And this is also the KE. And I also recall you that the beta of the stock is 0.6, and the beta of the stock is also the operating beta, okay, which makes sense because there is no debt in this firm. So beta of the equity, so I call beta only like the beta of equity. Okay, and this is the beta of the operating asset. So I'm on the asset side of the company. And now what we do is we leverage the company. So what we do is we do a debt recap. So you have all that explained in the handout. So what we do is that we raise leverage. So we raise new money. We raise 200 million euros of leverage. And this leverage, we pay it as dividend. Okay, so what happens is that you raise money, and as soon as you have the cash, you pay out the money under an exceptional dividend to shareholders. Okay, so what you have here is that I'm going to do it too big, okay, so that I have some space here. Okay, so what you have here, okay, so this is the value of the firm. I don't know what it is, so that's a question, okay? And what I know is that the value of leverage is 200 because I'm raising this leverage. And I still have, so now if I write down the operating profit of the firm was 110, 90, 60, okay? And this, we are going to think about what is it, what do we have to pay on the debt. Let's assume that this debt is a perpetuity, so meaning that you raise a debt, which is a perpetuity, or meaning that you raise a debt and then you will issue new debt when the debt arrives to maturity. So this is the equity of pharma. And the question, of course, is what's the effect of doing that on the firm value? What's the effect of doing that on the equity value of the firm? So now I go to the first question. So everything is written down in the answer. So maybe I'm going to upload that at the break. Because I think I have to go out of the sessions. Okay, so but let's look at what's written here. First question is show that the debt of pharma is risk-free. Please, 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 always remember that. The debt is risk-free, okay, if you cannot imagine any state of nature, you cannot imagine any scenario where you cannot pay the interest payment. Okay, so how do we do that? Well, if the cost of debt was risk-free, the cost of debt would be the risk-free rate. Risk-free rate in this case study is 7.5%. Okay, so what we do here is make the following reasoning. If you issue 200 million euro of debt, multiplied by 7.5, you will have a coupon payment of 15 million euros. Okay, and what we observe is that even in the worst case, the operating profit is 60, and with 60 you can easily cover the interest payment. So what does it say? Well, it says that obviously the debt is risk-free. So that's the way to look at that. Is there any scenario that you can imagine? No, in the worst scenario, you can always imagine, you can always repay the debt. So here we can complement and say, well, you know, the payment that you will have here over the debt is going to be 15%. And we can also state that the cost of the debt is, this case, equal to the bond yield and is equal to 7.5%. Okay, and is the risk-free rate. Okay, so KD, cost of debt, yield on the debt, 7.5, and it's also the risk-free rate. Okay, so now what we will do here is the question, the next following question is to ask, what's the valuation of the equity? And in order to do that, what we do is exactly what we did before. Exactly what we did before when we were asking ourselves, what's the value of the firm? What's the value of the equity when there was no leverage? So we will do exactly the same thing. And how do we do that? Well, the way we do that is we look at the return. And what would be the return? Well, the return is, in this scenario, you would have 120 minus 15, so 15, 75, 45, divided by the value of equity. Okay, so your expected, so your return, okay, will be 105 over E tilde, E prime, etc. And on average, okay, your expected return average, okay, will be 75 divided by E prime. And this is E prime. Okay, this is the cost of equity of the firm. Okay, and the cost of capital, we don't know. The cost of capital, I'm going to call it K prime for the moment, but of course K will be different than K prime because you have some leverage. Okay, so let's go now in the handout a little bit. So what do we do? Well, what we do is exactly what we did before. So exactly what we did before, meaning that, okay, we compute the return. That's just what we did. We have the return on the market. Okay, we use the same methodology as in part 2. And what we write is that the earning, the expected earning is equal to so we use the capital asset pricing model, okay, equation, and we write that the return is the risk-free rate plus market risk premium multiplied by beta. Okay, and this is the expected return. Okay, this is the beta. Okay, so how is it the beta? Well, remember that, okay, after simplification, okay, so the beta, okay, if you compute the beta, okay, sorry, okay, remember after simplification, it used to be, I've been losing you here, but I think in the room it's okay, it's just the Wi-Fi here. Okay, so the beta, remember, so beta is going to be covariance Rn over variance Rn, and after simplification, you know, it's going to be 30 divided by E prime. That is to say, you know, we were looking at difference over this difference after simplification. Okay, and this is why it turned 600 divided by this. Okay, so you can make the computation and you will see that it gives you that. Okay, and if you solve that, you're gonna have E prime is 800 million. Okay, so now I've been using you here.
Don't know why. Yeah, big blue button is dead. Let me see if I can join again.
Okay, so E prime is equal to 800. Okay, and E prime is equal to 800 means that now we know here that it's 800. And so if E prime is 800, it means that the valuation is still going to be 1 billion. Okay, so 800 million, 200 million for the debt, so the firm valuation will be 1 billion. And so it means also that the cost of capital of the firm will be the same. And the cost of capital of the firm is unchanged. So what are we using here? What we are using here is capital asset pricing model. We are doing a debt recapitalization where we issue debt. Okay, we pay out this into the form of dividend, and we look at the valuation, and we look at the firm valuation, right? I have a connection problem with Canvas now. Okay, let's see. Okay, so what we are discovering here is just the result of Modigliani Miller. If a firm is leveraging and there is no tax shield to leverage, here taxation is 0. Okay, so the tax rate on income is equal to 0%, so there's no taxation. Then what will happen is that the firm value is unchanged. So we are just discovering again Modigliani Miller. And you will see that this case study is really interesting to go on with everything and understand things that are important. So what's the firm value? 1 billion. What's the cost of capital? 9%. So what we observe is K unchanged, V unchanged. Same result as Modigliani Miller, except that we are not using a trade-off reasoning. We don't make here a trade-off between the stock of the leveraged firm and the unleveraged firm. What we are using here is sorry, I'm trying to reconnect at the same time. It's not easy. What we are using here is just capital asset pricing model, absent taxes, and we find that the firm valuation is unchanged when you leverage the company. Okay, so now if we go back to do another more computation on that. So what we have here is that the beta operating will still be 0.6. Okay, so if I add that here, so the beta operating is going to be 0.6. The beta of the stock, I'm going to write it here. So the beta of the stock, so beta operating is 0.6. Beta of the stock is 0.75. Okay, why 0.75? Just because I use the computation that we did before. So it's 600 divided by E prime, so 0.5, 75. Okay, and what we can check, okay, is that this relation that you know is holding. That is to say, the relation between the operating beta and the beta of equity works. Okay, and we can observe that we have that. Okay, now most important is to look at the. I think you can hear me, but I like to see the chat. Connected, so I don't know why Canvas is not working anymore. with my laptop. I'm going to check that you are still here. Okay, sorry guys. Yeah, you're still here. Good. So no, because I don't know for what reason my other computer, cannot access anymore. I see that at the break. Okay, let's work out. I wanted to control that the connection was okay. Okay, so what I do here is compute the volatility. Okay, so what I do here is just look at the volatility of the unleveraged firm and the volatility of the leveraged firm. Okay, and in order to do this computation is just 105 divided by 800. This is 75 divided by 800 and 45 divided by 800. Okay, and if you look at the volatility is this and volatility is this. So if you compute the volatility, you have an increase, okay, in the volatility. And what you can remark is that there's a relation between the volatility of pharma and the volatility of pharma leverage is increasing given the level of leverage. Okay? And I think this is something that you really have to understand why. That's very important. Hold a second, I just close the door because it's noisy. Sorry. So the weather is beautiful outside, so many students are in the courtyard here at the school. Okay. So what is happening here is the volatility is increasing. But what I want you to understand is why the volatility is increasing. To understand fundamentally why. And to understand that is just do some kind of a little bit of maths. If you look at not the maths, but just understand. So if you look at the 9 and 6 here, the way we compute that is 110 over 1000, 90 divided by 1000, 60 divided by 1000. Okay, so in a certain sense, what makes the volatility is the fact that you have operating income of 90, 120, 90, and 60. Okay, and so it means that if you come from scenario 1 to scenario 2, okay, you are losing minus 30. And if you go from scenario 2 to scenario 3, you are losing minus 30. Except, and that's what you observe. Here, you lose 30 and you lose 30. Okay, that's normal. That's the operating income. And what about when you have leverage? Well, when you have leverage, you lose 30 and you lose 30. That is to say, equity holders, they will have 1.5, they will have 75, they will have 45. Why? Why this? Well, just because you have the operating income, and on this operating income, you pay 15 to leverage, and then this is the equity. Okay, so your equity is declining by 15 in all the scenarios. And you still have 30, 30, 30. Okay, so you still have the same decrease if you jump from one scenario to the other. So now, why is it that the volatility is increasing? If you look at that, why is it that the volatility is increasing? Well, the volatility is increasing because now you have leverage. You have 200 of leverage. So it means that your firm is financed with less equity. So you have less equity in the firm. Okay, here you have 1 billion of equity. Here you have 800 million of equity. So the level of equity is increasing. But what is a return for shareholders? Return for shareholders are the flow for the shareholders divided by the value of what you invest. And as the value that you invest is lower, what will happen is that the volatility of the return is increasing. So You take the same difference, 30, but you divide by a level which is higher. So the fact that you have more equity will smooth the volatility of the return. On the contrary, okay, if you remove something for debt holders and the value of equity is going down, then even if you have the same change in earnings, this is the same change, but you have the same change divided by a level of earning which is lower. And this level of earning and this level, of equity which is lower makes that your volatility is increasing. So that's very important. That's very important to understand that this is not, the debt is risk-free. This is risk-free debt. So the risk that's provided by leverage to shareholders has nothing to do, okay? Has nothing to do with the problem of risk on the debt. It has to do with the fact that when you leverage the company, you reduce the level of equity, and if you reduce the level of equity, a certain variation which translates into a higher volatility. And so that's why, as volatility is increasing, then what will happen is beta will increase. Remember, so how do we have this given the relation on the volatilities? Okay, we have that. Why? Because remember, it's done in the. Okay, why do we have that? Well, just I recall you, okay, that the beta is going to be the correlation of the stock pharma with the market volatility divided by the volatility of the market. Okay, so what does it mean? It means that if the volatility is increasing, as here the correlation is 1, as we said before, so if the volatility is increasing, then the beta is increasing. Okay, and what you observe in terms of relation on the volatility, you have the same relation on the beta. Right? So what's really important is that it's in your mind, and you keep that along all your career. That you take a company, you take some real estate, you take anything, okay, if you add some leverage on a risky asset, what you will do is that you will increase the volatility for the equity holders, and this is mechanical, okay? It's like physics, okay? We said this before, but it's like physics. There is nothing to argue about that. It's not about, but the debt may be risky or not risky. No big deal. Sole thing here that is important is if there is less equity, there is more volatility because the same variation transfer into a higher volatility of the return. Okay, so what about the cost of equity? Well, of course, the cost of equity was 9%. Cost of equity becomes 9.375%, increasing. So here you have so this is the average. Okay, so if you take the average return, it's going to be 9%, and average return will be this one. So of course it is increasing. So why is it increasing? Well, it's increasing because there is a leverage effect on the return. But this leverage effect on the return, okay, is associated with an increase in the risk. Okay, so you have a certain level of risk, you have another level of risk, but the risk is increasing. So you have an increase in risk and you have an increase in the return. Okay, and what's the result? The result again is this one. Okay, is the following one: is you have RF. Okay, you have here your value of pharma with no leverage, and what you do. Okay, this is the value of equity with leverage. Okay, so this is just the operating risk. This is the K, and this is the KE, and this is the volatility of the stock. So what you do here, again, is having some leverage. If you are able to borrow at the risk-free rate, what you do here is you go on the slope here, and you go on the right, and you increase the return, and you increase the risk. So, remark, what you can observe, but you know those kind of relation, of course, is the KE is equal to K plus K minus KD D over E in the case of no corporate tax, okay? And we can observe that 9 plus 9 minus 7.5 multiplied by D over E, D over E market value, is going to be the what we observed before. So we are able to compute the KE after leveraging the company. So to conclude on this case, leveraging the company does not create value. What it does is increase the risk, increase the return. As long as the free cash flow is not affected, leverage has no effect. So we are not using Modigliani-Miller. We will see now quickly Modigliani-Miller. What we are just doing here is using the capital asset pricing model to check what would be the effect of leverage on the value of pharma company, just using standard capital asset pricing model valuation as we did before. Okay, so this is where I wanted to lead you with the pharma case study. So I'm just checking my clock. 1 second. I think we can maybe slightly go on still a little bit on that. So that's really important. And this case study that I will upload, you will have it tonight. I will upload tonight. When I'm in my office, I want to avoid problems because you already have. So now are you back? Cannot upload again. So here you're back. Good. Okay. Yeah, so now there's a big echo. So I'm gonna stop this one. Okay, so you are back. Good. So okay, so now what I want to do quickly, maybe is just discuss a little bit of the beginning of Modigliani and the relationship. So with the case study, you have the important things. Now I'm gonna go through a little bit quickly. We have to discuss that a little bit, know where it comes from, in order to have like an advanced course that it's not only knowing about it's not knowing only about the formulas, but understand where they come from, appropriate more of those formulas. I'm gonna just put some light here now, and I'm back. Yeah, because now I think it's better for you. So quickly, very quickly on that. Some people, okay, and I think it's enough, it's important enough so we can spend 2 minutes on that. Some people say, and even maybe among the professors that you had in your life, or maybe in the program, I don't know, we say, leverage is interesting because leverage is increasing the return on equity. So you have a leverage effect on return on equity. When we are discussing return on equity, we are not discussing KE. We are discussing accounting figures. So, of course, there are similarities, but we are really not discussing of something extremely different. So let's hear quickly on that. So return on capital employed, return on equity, cost of debt after tax, accounting value. Okay, and what we write here is that the capital engaged is equal to the book value of equity plus the book value of the debt. And now what I want to use, okay, is just use the return on equity. So the return on equity is going to be the NOPAT minus, so return on equity, as you all know, would be net earnings, okay, divided by the book value of equity that I call E. Okay, so this would be the return on equity. But return on equity will be NOPAT minus the cost of debt, return on the debt, I call that here like that, ROD multiplied by the level of leverage, divided by E. Okay, and now if you use the fact that, okay, now what you can also say is that the NOPAT is going to be the return on capital employed multiplied by capital employed minus ROD multiplied by D over E. So here I am. Okay, so the NOPAT minus the cost of debt after tax multiplied by the level of leverage divided by E. And what do you do with that? well, here what I do from this line and this line is just write down that capital engaged is E plus D, okay? And of course, then what you do is just divide by E here, okay? And you will have a D and D, and you can rearrange that and write this like that, okay? So what is that? Something that you know, is just that the leverage effect, that's just the leverage effect of, that's just the effect, sorry, of leverage on the return on equity. And what you say is that, well, if return on capital employed is over cost of debt, the ROE increases with the level of debt. Okay, some people tend to say, that's good, that's great. Because, if ROE is better, then it's great. Like in banks, people like a lot return on equity. In corporation, we use less return on equity. But, if ROE is coming from 10 to 15, maybe it's good. Yes. But the problem is we cannot say very much about all that. Why? First, because we are using accounting figures. Okay? We are just saying, well, there's an increase in the return. We are not saying this leads to value creation. The stock price will increase, the fair value will increase. And second, okay, each time you tend to think about some return, you have to think about risk. So please remember that return, risk all the time. The problem is to speak about internal rate of return, to discuss about ROE, to discuss about return on capital employed, to discuss return of stocks and not think about the risk. Okay, so in order to be able to know what the effect of that is, okay, we are first to look at something else than accounting measures, and second, look also at the level of risk. So so here is the pharma case study. Here is the pharma case study. So maybe I'm gonna just start with that, and maybe so that during the break you can also take a look a little bit at the proof of that. What's the story? The story, and what's the question that we want to ask? The question that we want to have with leverage is the following. Imagine that you have a company, okay, and this company has a little bit of leverage, okay, and the cost of equity here is 10%, and the cost of debt is 2%. Okay, so the company has a little bit of leverage, and we are in a world with no taxes. Okay, so there is no corporate income tax, okay, right now. We will have time to discuss about corporate income tax, and you'll see it's not easy to think correctly about corporate income tax. So the idea is that leverage is like that, very small. And of course, you can state that the WACC of the firm is KE E over V plus KD T over V. So you have a certain level of WACC. Okay, imagine that the WACC is whatever, 8%. Okay, so you have a weighted average cost of capital of 8% given a level of cost of equity and cost of debt on the market. Well, you also know that the firm value, okay, you also know that the firm value is the sum of the free cash flow divided by the cost of capital, okay, where the cost of capital is the required rate of return on your operating asset given the level of risk. But we also know that the cost of capital is equal to the WACC. The asset side cost of capital is equal to the liability side of the cost of capital. So WACC will be the weighted average cost of capital. I take into account the liability structure and equal to the cost of capital of the firm. And so my intuition, okay, my intuition could be the following, is that if I increase leverage, so imagine that I can increase leverage, and imagine that the leverage here will cost me, okay, so this additional leverage will cost me also 2%. Okay, why? Because it's risk-free. Okay, so 2% is the risk-free rate. I have very little leverage. If I add a little bit of leverage, it's still risk-free. So I still have 2% cost of debt. What I could imagine is that so what will happen here? Okay, so you increase leverage, and this leverage is paid out to equity holders. This is just pharma case study. Okay, what we could imagine, okay, is that because we increase leverage, okay, and decrease equity, and that KE is superior to KD, then the WACC will decrease. This could be an intuition. Okay, and now I'm discussing about leverage effect, but seriously. That is to say, if I increase my leverage and the cost is the debt is less costly than the cost of equity, which makes sense because the leverage has priority. So why? Because leverage has priority on the equity. So there's less risk. And so if it's the case, then that is to say, if it's the case, so it means that this would go down, this would go down, and if this would go down, then it means that the valuation of the firm value will increase. And as the value of the firm is E plus T, so it means that if this is increasing, then it means that the value of equity will increase. So the idea that if I bring some additional leverage in the firm, then maybe my WACC will go down because financing of the firm is less costly, and then the cost of capital is declining, firm value is increasing, equity is increasing. So why is it incorrect? So what does the pharma case study tell you? Pharma case study tell you, no, wrong. What pharma case study tell you is that it's not changing. Okay, this is not changing. So if that not change, the WACC is not changing. And why is the WACC not changing? Because what you should not forget is K is increasing. So if you add up some leverage in the firm, okay, then maybe you have less equity that is more costly. You have less equity which is more costly than leverage, but at the same time, what will happen is the cost of equity will increase. And why is it that the cost of equity will increase? Because the volatility will increase. Okay? So that's exactly what we did with the pharma case study. So now, what we want to do is just use, and I can show you that quickly, and then we do a break, maybe another effort, just looking at the time. Oh, okay, maybe we can, we can just begin like that. So the idea is that what's the objective could be to determine whether some capital structure can minimize the WACC and would increase firm value. And we know that it's not the case with the pharma case study, and pharma case study, that's just the one we did here, okay, will tell you, no, it will not be the case. And the pharma case study is using capital asset pricing model, so it's not using Modigliani. So Modigliani now, what is that? In fact, the other guys that look at this idea are Modigliani Miller. And it's very important in corporate finance. It has to be taken seriously. To really think it's really, when we were discussing capital asset pricing model, and you have A and B and C, and then the beta will be the average beta, and the cost of capital will be the average of the cost of capital of all the assets. And now we turn to the liability side, and we say, well, this is financed by leverage and equity. Okay, and what we will say, okay, is that the beta on the liability side will be the average beta, and the cost of capital will be the average cost of equity and average cost of debt, etc., etc. And if you change that, it will not change the cost of capital and will not change the beta of the average beta on the liability side. Okay, so that's really important to really think well about all that. So, of course, what are the important things that you have here is that, of course, we have standard hypotheses that perfect capital market, information is free, identical for all investors, claims are indefinitely divisible, meaning that even if you have $1, you can buy the world because you can just buy a very small portion of assets. Borrowing and lending rates are equal. So all this is classic standard assumption of functioning of capital market. And I'm not going to go too quickly into that, but there is no transaction cost, meaning that if a firm is bankrupt, it means that the firm goes in the hand of debt holders and it has no cost. and there is no taxation, that is to say there is no bias, there is no taxation at the level of the corporation, at the level of the equity, at the level of the dividend, at the level of the coupons, etc., etc. So it's a world without taxation, and there is no governance problem, okay? So that is to say, at the head of the firm, you have a manager that really works in the best interest of shareholders, maximize the firm value, okay, without any issue of governance or self-interest of the manager. Okay, so let's just say something, and maybe we do a small break before we look at the reasoning. So Modigliani and Miller is considering two firms that belong to the same operating risk class. So what does it mean that you are in the same class? It just means that, okay, if you take the free cash flow of one, okay, and if you take the free cash flow of two, okay, and this is the state of nature, and if the free cash flow is always the double, okay, so each time the free cash flow is the double of the free cash flow of two, so this means that the two companies belong to the same economic risk class. It's like it's something related to the industry. So it means that companies are really affected in the same way. We are in 1958, so we are before the capital asset pricing model that was 1962. What we know now is that the volatility that will trigger an effect on the cost of capital will be macro variable. So it's going to be the euro dollar, it's going to be the consumption, it's going to be the GDP, the COVID, whatever, all things that may move the stock market. Okay? So this would be the things that will be important because they'll be inside the beta and the cost of capital of the firm. But anyway, so this is, okay, here is a very restrictive definition of risk of Modigliani and Miller. So I'm going to go through the reasoning and then maybe we'll do a break. What time is it? No, we'll do a break now because, you know, I need maybe to drink something. So please, if there is no question on the chat, I'm going to hurry a little bit to finish that so we can move to other things. There are many. I want tomorrow to start option and using option pricing for valuation, which is extremely nice. You will see it's a beautiful way to compute value of equity, value of leverage, value of junior debt, convertible, and all that. And I will show you how you can use that and really improve your way to assess the value of certain claims. Okay? But first, I want to finish that. It's important. And, you know, like the case study, I mean, 60% of the case study that I will give you is based on that. Okay? So there will be three parts, but the first part will be to have like a case study of a firm that is changing its leverage, cash, assets, buying another company, and using correctly all that to make the valuation of all that, and using the correct reasoning. I'm not saying that you are already able to do it. We still have to go some exercise, case study, etc. But first, I want to make sure that you know and understand all the concepts. I suggest we make a 10 minutes break. Okay? 10 minutes. So, what time is that for you? So, no, let's say, no, 15 minutes. Let's be serious. So it's 3:40 for me. So I think I cannot remember. It's 8:40 for you. So let's say 8:55. 15 minutes, okay? See you in a minute. And please, if there is any thought, you write that on the chat. When I get back, I look at that. Okay? Any question? Okay, thanks. Thanks, Frank, for being with me. Very happy to see you. See you in a minute. 15 minutes. Okay, I'm back with the chair. Which is gonna be better, so I can sit and have the screen here. Okay, so 1 hour, so let's be efficient. For the last hour, I was a little bit longer. So here is just the proof. I think it's nice in a finance master program to know where the Modigliani-Miller proof come from. Okay, so the idea of the proof is quite easy, not very difficult to follow. And I'm gonna open a slide here so that okay, so I'm opening a slide here to understand where it comes from. Let's just look at the L and L. Oh, okay. No, here is the proof. Okay. Okay, so we will go back to that afterward. I'm jumping on that. Okay, so called X, E, A, B, R, D, B. Okay, right. Okay, so I'm okay. So let's see. Okay, so what's the proof? In fact, Modigliani-Miller, what they're saying, say, let's consider two firms. So let's consider two firms, A and B. Okay, but VA is equal to EA and VB is equal to EB plus DB. And the debt is risk-free. And the two firms, they have the same, okay, so you have the same operating cash flow, which is X, okay, and you have the same risk. Okay, so basically A and B are two firms that are exactly equal in terms of operating asset, okay, X, except that this firm has no leverage and this firm is leveraged. Okay, and what you pay on the leverage is RDB. So that's just the interest payment. And so it means that the free cash flow to equity is going to be RDB. Okay, and what we will consider is that X is stable. Okay, so X is stable, meaning that the value of the firm is X over K. Okay, where K is the cost of capital of the firm. Okay, so we have two firms. So, and the idea is that imagine that VB is over VA. That is to say, we consider that if a firm is leveraged, the value of the firm is over the value of the unleveraged firm. Okay, so imagine that the fact to leverage, so imagine that because of leverage, hold on, I'm gonna close. Yeah, students have exams, so they're a bit noisy outside. So imagine that VB is over VE. And you know, we could imagine that because I am able to leverage, my return is increasing, and at the end of the day, you know, stockholders will pay a higher price for the stock. Okay, so there will be a leverage effect on the firm and the equity valuation of the firm associated to this leverage. Okay, so what Modigliani-Miller are doing is they are using what they're doing is they are using a trade-off between A and B to show that it's impossible. Okay, that on perfectly functioning market, it's not possible that VA is different than VB, and that VB is over VA or that VA is over VB. In fact, they show it in both ways. So let's look a little bit and we'll come back on that. Okay, so let's forget about that. So consider two firms A and B of same economic risk class, same average expected free cash flow called X stable to infinity. A is unleveraged, B is leveraged. Okay, and suppose that VB is over VA. So if VB is over VA, okay, let us show that an arbitrage profit is possible. So what do we call an arbitrage profit? Is the possibility to make a gain without taking risk. Okay, so if you can make a gain, a certain gain, with no risk, is something that is not possible. Because if there was a gain to be made, then people, arbitrageurs or speculators will take position so that as soon as some trading profit, arbitrage profit appears on the market, it disappears. No, I'm going to close the door also, sorry. Okay, when I speak, it interferes, so it's difficult to think and listen at the same time. So, okay, so what we have, so making an arbitrage profit is comparing two situations. So what we will do is compare the situation. We look at the annual income for the shareholder of company B, and then we do a trade-off. So let's see how it works. And for that, I come back. So here, what we do is, let's imagine that I have alpha% of the stocks here. So what I'm just saying here, so I compare my situation, I have alpha% of the stock. So it means that my annual income return is going to be alpha x minus RDB. Easy. Then what I do here is I sell my stock. So I sell alpha EB. Plus, I leverage myself as the company is leveraged. The leverage of the company is DB over EB. So imagine that you have 1% of the market cap. It means that with the firm, okay, you are accountable for 1% of the leverage. So what you do here is you sell your stock. So this is some cash. This is your equity. And then you will take some leverage. But this is personal leverage. And so at the end of the day, you have alpha VB. Okay, you have a certain amount of money composed of cash, equity, and composed of personal leverage that you have been borrowing on the market. And what you do with this money is that you invest in this company. And as you invest in this company, you get alpha VB over EA. But so it's like I have 100 and I buy something worth 1,000. So you have 10%. So it's a percentage. And so I get alpha VA. Sorry, I got alpha VB. Okay, so this would be, all this is written down, but I prefer to do it with you. Alpha VB over VA. So that's a percentage. Okay, and so what's your income now? Well, your income now, so I make the trade-off. I was a shareholder in B, sell my stock, borrow, invest in company A. So it means that my income now is going to be alpha VB over VA multiplied by X. So alpha VB over VA multiplied by X minus what? Minus, don't forget, you have been leveraging yourself. So what we will assume for the moment that we will justify that is that you are able to borrow at the same cost as the firm. And we will justify that. So if you borrow at R, it means that you have alpha dB of debt, so you have alpha R dB of interest payment on your personal loan. So here is the return, here is the income you get if you are investing B, but you can also invest in A, sell your stock, leverage yourself as the firm was leveraged, and get a return that is like that. And what we are interested in, and I'm going back to the slide because I'm not going to write everything, is to compare. Making an arbitrage is comparing two situations. I can invest in A, I can invest in B. I am invested in B, I can invest in A. But what I do is I leverage myself as the company is. That is to say, you have here a certain leverage inside the company, and here you have outside leverage. You have an outside leverage, and we invest in a company which is equivalent in terms of risk and return, but the leverage is at the level of the investor. So if you look at that, you're going to see it's quite beautiful to look at that. So this is YB, this is YA. Okay, then what we do is we compare the income. So we compare YA and YB. And it's very nice because it simplifies. So here you have alpha RDB, you have alpha RDB. So I do the difference. Go to compare means do the difference. Okay, and then I get YA minus YB, alpha X, VB, VA minus Y. So now remember that we are in the case that VB is over VA. So if VB is over VA, then it means that YA minus YB is over 0. And what is that? This is an arbitrage profit. Okay, why is it an arbitrage profit? Well, it means, sorry, so if this is positive, okay, sorry, if this is superior to 1, okay, if VB, not go too fast, it means VB over VA is superior to 1, okay, so it means that, okay, so it means that this is superior to 0, and so it means that YA minus YB is superior to 0, and this is an arbitrage profit. Why? Because you are making a certain gain without taking any risk. You don't, you have a certain level of equity, you sell your equity, borrow, invest in a company, you don't bring new money, okay, you don't bring new equity, okay, the sole thing that you do is you leverage yourself, but there is no additional equity, there is no additional risk being taken. And what you observe, okay, is that, so what will happen? Well, if there is, if it is interesting to buy A and sell B, so what will happen is everybody will buy A, so the value of A will increase, and everybody will sell B, so it means that the value of B, and therefore the value of VB will decrease. And when does it stop? When does it stop? It stops when YA minus YB equals 0, and this is equal when VA equal VB. Okay? So the idea is that there is no arbitrage profit anymore when the value of A is equal to the value of B. Okay, so what do Modigliani Miller show using this trade-off? Well, very cleverly, what they show, okay, is that if you take two companies A and B with the same level of risk, that have the same operating income, they have the same value, okay, independently of their capital structure. Okay, so now there is just one remark. Okay, why is it that the personal debt of the investor is risk-free? Well, you know, it's not that complicated. Just look down what I wrote here. We use the fact that the debt of B is risk-free. What does it mean that the debt of B is risk-free? It means that excess, it means that whatever the scenario that may happen, excess, the free cash flow is over RDB. Therefore, we can write down that alpha excess is over alpha RDB, it's just maths. and then I can also multiply this by VB over V1 superior to 1. So, again, a fortiori, what I have is that alpha VB over VA XS is superior to alpha RDB. Okay? And what does it show? If you look at just this here is just what you have here. That is to say, what you have here is whatever X, okay, this, forget about that. What we have is that this, what you get as a return of the stock on company A is over what you have to pay in terms of interest rate. Okay, so what does it mean? It means that if I go here, that it's smart. It's just that if this debt is risk-free, okay, and if you borrow the same amount of debt, if you borrow the same proportion of debt and you invest in company E, okay, as the level of risk is the same, as the level of risk of the two companies is the same, then the personal leverage will be risk-free. So this justifies that here, the R here and the R here are the same. So if the leverage of the firm is risk-free, the personal leverage of the shareholder when he invests in company A after leveraging himself is risk-free as well. Okay, so that's the story and that's the reasoning of Modigliani Miller. So that's the proof. So you have it. It's a beautiful reasoning. It's not that complicated. You can rethink about it. It's just comparing to investment. Okay, and saying that on a capital market that function well, there is no trade-off possible because as soon as you have an arbitrage profit like that, people will try to benefit from that. So they will buy A, they will sell B, and then the value will change. And of course, there will be no trade-off profit when VA equal VB. So it means that, in order, at the equilibrium of the market, we have to have that VA equal VB. So let's look a little bit at what I wrote here, so that you have this in mind, and there is just a good takeaway of that. If you consider two firms that have the same free cash flow, one N leverage and the other is leverage, okay, investing in L or investing in N with a leverage at the personal level that replicates the capital structure of L should provide the same payoff to an investor. Okay? And under the hypothesis of perfect capital market and no transaction cost, the payoff is equal if the value of L and the value of N are equal. Okay? So it shows that the sole way that you can equilibrate is that the value is not increasing. And the important takeaway from that, there are many takeaways from that. No, maybe I haven't written that here, so maybe I should state that. Is that, in fact, the idea is that the way to split when you have a capital structure on assets, okay, is just a way to split the free cash flow and repackage them to the investors, which does not create wealth. Okay, the sole thing that will happen, okay, is that you have, think about the pharma case study. So you have a certain asset, you have only equity, you have some leverage. What you do here is you do a risk-free asset, cannot be not risk-free. And then what it does here is that we create two assets and this asset become more risky. Okay, so the K will increase, but the risk will increase. But in a certain way, the way you split that has no effect on the size of the pie. So V is a pie, okay, and the way you split the pie has no effect on the size of the pie, okay. The sole thing that it changes the risk and return of the claim that you have been creating on the pie, and the pie being the operating asset of the company, okay. So that's the important thing behind that. If I add two other things on that, and that you may still want to have in mind, okay, is that, well, if V is not increasing, so if I leverage a company and V does not increase, it means that K does not increase. So K is unchanged, okay? So, of course, if V does not change, if I increase leverage, V does not change, so it implies that K does not change either. Okay, and something more important than that, something important that you can use, very important to use, and you will see. Okay, imagine that now you have company 1 and company 2, and imagine that the free cash flow of 2 is twice the free cash flow of 1. So the company 2 is 2 times bigger in terms of free cash flow, and they have the same risk. Okay, so you have the same operating risk. Okay, they belong to the same economic risk class, same industry. Okay, so what Modigliani Miller will tell you is that imagine that you have D1 over E2 and D2 over E2 are different. So, one firm is leveraged, the other one is not leveraged, or they have different leverage. What you know is that independently of the leverage, K1 is equal to K2. So it means that, if when a chain changes leverage, cost of capital does not change, it means that if 2 firms are in the same industry with the same underlying risk, but they are different by their capital structure, the cost of capital will be the same. Always with taxation equal to 0. So what does it mean? Well, it means that V2 is equal to 2 multiplied by V1. So imagine how it's nice. It means that you can compare. Modigliani Miller tell you something that you can compare the firm value 2 with the firm value of 1. Okay, and this comparison, okay, is based on the arbitrage, the absence of arbitrage. Profit, okay, leverage does not affect the cost of capital of the firm, does not affect firm value and the cost of capital of the firm. So I'm able, okay, to have something like that. By the way, if you look, what does it mean? What does it justify? If you look at this, if you look at that, what you can observe is that I call M1 as V1 over free cash flow 1 and M2 as V2 over free cash flow 2. Okay, so these are the multiple of the free cash flow. What will happen on the multiple is the same. So what I'm saying here is that when on a capital market or when on a market we are using comparables, we are using multiple in the same industry. Okay, you take a multiple of firm value 10, okay, and you say in this industry the multiple is 10. We are basing our reasoning on Modigliani Miller. This is Modigliani Miller that will tell you, independently of the capital structure of the firm, okay, the multiple of 2 firms in the same industry with the same underlying risk will have the same year multiple. Okay? Here I assume for the moment there is the same growth rate. Okay? So here I have also the same growth rate for the moment was 0. But anyway, okay? So here I just show you how it works. Okay, so let's go back on the slides. So what we also know is that nevertheless, when a firm swaps debt for equity, what we do is replace a financial claim that is more costly with one that is less costly. And this what I'm referring to is just this KE over V plus KD over V. So we have been discussing that, okay? So we have been discussing that and we say, okay, so if I increase that and decrease that, so it means that we may believe that this decrease, but this is equal to the cost of capital and the cost of capital is not decreasing. So this is wrong, okay? So what will happen is that K will increase, okay? So the idea is that when the firm is leveraging itself, K is increasing. And using the WACC definition, okay, it's very easy. I'm not going to do it here. It's easy. But if you use this formula and you write down differently, you solve for KE. It's not really difficult. So just, I'm going to do it here, KE EV plus KD DV. Okay, and what you do here, you have this the other way around. So I'm going to write KE EV equal K minus KD DV. Okay, so here I have KE, multiply VE K minus KD, D over V. Okay, so I'm just solving for that. Okay, here I have V and V here. So here I have minus KD DE. And I also have VE K. Okay, not that difficult, but then V is equal to E plus D over E, K minus KD DE. Okay, and this is K plus D over E K, D over E KD, K minus KD D over E. Here. Okay, so that just, I'm just writing down the WACC, okay, and solving for K. Okay, and I have that. So now is something that is important, okay, and please, I think one of the mistakes of Modigliani-Miller is they did not explain enough, okay, and Modigliani-Miller is not well understood even by finance professors sometimes, okay. So what Modigliani-Miller is telling you is that when, okay, when take the two pieces together, first proposition, V, when D over E increase, V does not increase. Okay? And the stock price, so there's no value creation and the stock price does not increase. Okay. So when D over E. And second proposition is KE is increasing. But KE is the expected return. So think about that. That's very important to bring the two pieces together. Okay? If you have a return of 10% and the return becomes 15%, you may say it's good. And what does it mean? Good. Good would mean stock price increase. But we know from capital asset pricing model, we know from Modigliani-Miller and the trade-off arbitrage that stock price is not increasing. So the stock price is not increasing. So if stock price does not increase, whereas return is increasing, what does it mean? It means that the 5%, the plus 5% that you have is just a risk premium. It's just the fact that when you leverage, okay, you increase the volatility, and this volatility increase the expected return because the required rate of return is increasing. So in a certain sense, when you leverage, there is an increase in return, but there is an increase in the required rate of return. Okay, so that's why the value is not increasing. Okay, and this is exactly what we observe with the pharma case study. As the increase in the return does not lead to wealth creation, it rewards an additional marginal risk linked to the change of capital structure. Here is a case study that I'm going to share with you. So case study is like a small exercise, not very complicated. It's like pharma, so it's just, but there is a question 4 that I am interested in, is when the debt is risky. Okay, so far we have been discussing risk-free debt in the case pharma, in Modigliani-Miller. What happens when debt is risky? And that's very important. And I'm going to end up with a graph so that you keep that in your mind, and very important. So imagine that you have two companies, N and N. So very basic. So you have number of shares, stock price, number of shares, stock price, value of debt. So this would mean that the value here, the value of N is En equal 10,000. And here the value of L is equal to EL plus D, and this is 5,000 plus 5,000 being 10,000. So you can see from this that I have two firms that are identical in terms of same annual expected operating income, assumed stable in the future, one 500 in a good state of nature, 500 in a bad state of nature. So I consider that there are two possibilities for the operating income of this company, and I consider that everything that is earned by the firm is paid out in terms of dividend. Okay? So here I have two firms that differ, that are comparable in terms of operating risk, but are different by their capital structure. Okay, first question. First question, what are the earnings per share and the stock return for N and E in the two scenarios? I jump to the answers because it's easy. So here I do a table that I have the good state, bad state of nature, for N, for L. Okay, and I look at earnings per share and stock return. So earnings per share, to make sure everybody understands, so earnings per share will be 1,500 divided by 1,000 shares. Here is going to be 500 divided by 1,000 shares. And what about the stock return? Well, the stock return, remember, I'm not going to go back on what I said before, but if you pay everything on dividend, it means that the dividend per share is equal to the earning per share. The stock price is 10, so it means that this is the earning per share equal to the dividend per share divided by the stock price. And here is going to be 0.5 divided by 10, 5%. Okay, so everything from my return only comes from the dividend. Huh? Remember, it's when we said, okay, K equal dividend over C0 plus J. And I said J is C1 minus C0. And this is the capital gain. Okay? So if I pay everything, there is no capital gain. So all the return is coming from the dividend. Okay? Except that I take good state, bad state of nature. Okay. For the firm L, dividend is 1,550 minus 50. This is the interest payment. Okay, divided by 500, and 500 is the number of shares. It's going to be 2. And here is 500 minus 500 divided by 500, 0. Okay, and for the same reason, this is going to be 10 over 10, and this is going to be 0 over 10, 20 and 0 comes. Okay, so this is basic computation. Make sure that you are able to compute correctly earnings per share, return, etc., etc. Again, I've been using you. I don't know why I'm ejected from Canvas. I don't know if you are ejected from Canvas as well. This is when I am on the Wi-Fi. Okay, I don't like that because when I see you, keep an eye on what's going on in the room, thanks to my good friend with unmuted camera. It's wrong. I don't know. Technology is working when it wants, right? I'm gonna wait for a minute. Okay, I know you're here. So, earning per share, stock return. Okay, second question. So, what are the earning per share and the stock return of that? Done. Okay. What are the annual losses in dividends for the shareholders of both companies when the operating income decreases from 1,500 to 500? My question here is, okay, imagine that risk is here. This is the risk. So imagine that, it's like a stress. Okay? So this is what you have in mind that should happen to your firm. Okay, but you say, well, and then if the COVID is hurting a lot next year, what will happen? Or, if there is a lockdown because there is a new variant, or there is something bad, what's going to be the effect of my company? So, we are interested in what's going on when you go from that to that. Well, when you go from that to that, what you see is that what you lose for shareholders is you lose -1. So earnings per share will decline by 1, and you have 1,000 shares. So you lose -1,000. And if you go from year to year, and now you are in the leverage firm, okay, so you are in the leverage firm here, you lose -2, multiply by 500 because you have 500 shares is going to be 1,000. So what I'm seeing here is that if I am in an average firm, I lose 1,000. All the shareholders are losing 1,000. And if I am in a leverage firm, all the shareholders are losing the same thing. So my question is, why are we talking about risk? Because when you look at that, there is the same loss. And in fact, the loss that we are seeing is just the loss in the operating income. That is to say, we did a lot of computation to finally observe that if there is a loss of operating income of 1,000, then shareholder will lose 1,000. And why is it that shareholders are losing 1,000? Because the debt is risk-free. If you look at firm L here, debt is risk-free. Why? Because the operating income of 500 always covers the interest payment. Okay, so here the interest are 500, and you are at the limit of what the risk-free debt is. If you add an additional euro of debt, your debt will become risky. But this is risk-free debt. So that's what I write here. Okay, if I look at the annual dividend loss, okay, for firm N is 1,000 and for firm L is 1,000. And what we observe here is that shareholders bear all the variability in the operating flow. Why? Why? Because the debt is risk-free. Okay, because the debt holders are not affected by the loss. Okay, there is enough operating income, even in the bad scenario, to cover the loss for the debt holders. What is therefore the meaning of the financial risk? So this is the third question. Okay, what is therefore the meaning of the financial risk? Well, what is the financial risk? Where is financial risk here? Well, financial risk is here. Okay, so financial risk is just the fact that, okay, if the firm is unleveraged, in the good state you have 15, and if the firm is leveraged, you have 20 and 0. So you can really see that like that, okay, is that if you look at N, 5 and 15, this is operating risk. And if you are leveraged, then you have some additional volatility here, and this additional volatility that you have here, okay, this is associated with leverage. So what you have here, okay, is that you do have an increase in volatility associated to the fact that the leverage is increasing. And see that, if I turn back to the graph, and I'm going to remove a couple of things because it's difficult to see, so I still cannot access the website. For what reason? Okay, so if you look now at that, so what we said here is you lose 1,000. What you said here is you lose 1,000. Okay, so there is the same loss, and the loss is the loss in operating income. So every year, okay, if you go from the good to the bad state, you will be losing the operating income because the debt is risky. But here you lose minus 10%, and here you lose minus 20%. And why is it minus 10? Easy, because you lose 1,000 divided by the value of equity, which is 10,000. And this is exactly minus 10%. And here you lose minus 1,000 divided by the amount of equity of the leverage firm, and this is 5,000. And at the end of the day, that's minus 20%. So the idea is that the risk is the volatility of the return, and the volatility of the return is about what you have on the numerator, but what you have on the denominator. What you have here on the numerator, but what you have on the denominator. And in fact, because the company is leveraged, because the company has 5,000 of debt, it has less equity. And because the company has less equity, any change in operating income will transfer into a higher risk for shareholders. This is exactly what we saw with pharma. Okay, so I think now that you have really a lot food for thought about that. Okay, so last question. I am accelerating somehow because I want to try to finish with the capital asset pricing model to start option tomorrow. But if we still have a couple of things, we will do it. So imagine now that the value of the debt is 5,400. So I'm going to do a graph. Graphs are always important. Sorry. So if I do a graph here, it's like that. So what we have now is the following. Here you have the amount of leverage, and here in this graph I want to have K, KE, KD. And again, very important that you understand really what's going on here when leverage is changing. Okay, so what Modigliani and Miller tell us is K is not changing, whatever the level of leverage, the value is not changing and K is not changing. And here I have, here my debt is, here debt is risky, and here debt is risk-free. Okay, so it means that here is just the level of debt that the debt will become risky. So here this is company N, and here this is company L. So here the level of equity is 10,000, here the level of equity is 5,000, the value, and the value of leverage is 5,000. Okay, so and here is exactly my company L that I have in my case study. Okay, so what will happen is that when the debt is risk-free, okay, it would be the risk-free rate. Okay, up to here it is the risk-free rate. And then, starting from here, what will happen is KD will increase. And be careful, KD will not increase to infinity. KD will increase up to K. Okay, meaning that the maximum return, expected return, I recall you that KD is the expected return on the debt, not the yield. Okay, different than the yield if the debt is risky. So KD will increase, but KD will increase to be equal to K. And think like that, like if I am a shareholder in a company with no debt, I have a certain return. If I am in a company with a lot of debt, that is to say, here I have a company and it's only equity, and here I have a company and nearly it is only debt. That is to say, there is no equity. Equity is very, very small in comparison to debt. What we are saying here, okay, is the equity receive K, the equity receive K. And why? Just because if you look at these two graphs here, okay, what you've been doing is that the debt holders have been replacing the equity holders. You used to call that equity, you have a lot of debt, debt is 99% of the firm value, and in a certain sense, the debt holders exactly have the same risk as the equity holders are. So KD will be equal to K. So KE equal to K, and KD here equal to K, which is normal. It's just that we call that equity or we call that debt. But the cost of that cannot go to infinity. Okay, the RD will be a lot. Remember the difference between RD, the yield to maturity, and the KE. So now what will happen with KE? Well, KE is easy. We know the formula KE equal K plus K minus KD D over E. Okay, except that when you are here, so K is stable, but when you are here, KD is equal RF. So when you are below the threshold here, so what does it mean? It means that it's a line. So here you have KE equal to K plus K minus RF D over E. Okay, so this is what you have. And then what will happen afterwards? Well, what will happen afterwards, if you remember a little bit of maths, just to try to guess what is going on, it's like, you know, when you will be here, KD will increase. So it means that K minus KD will decrease. So it means that this is decreasing. So what will happen is that in a certain sense, this coefficient here will decrease, the B will decrease. So if the B is decreasing, it means that you have something like that. Okay? So this is exactly what happened. Okay? So it means that you have to have the weighted average of KD and KE, okay, equal to K. So what will happen here is that you have this kind of thing. So this, I want to pause on that because this is what professionals really have trouble to understand. Okay? That is to say, when debt is risk-free, the increase of risk is maximum. Okay? If you have additional leverage, you increase a lot the cost of equity. Okay? And when you have the same increase of leverage here, the risk is increasing less. And why is the risk increasing less? Because when the debt becomes risky, you create some risk for the debt holders. So it means that here, what happens is the sole people that take the operating risk are the shareholders. And because you have less leverage, okay, there is a high increase in risk for shareholders. When the debt becomes risky, the increase in risk for shareholders is lower because they share the operating risk. So there is a sharing of operating risk between equity holders and debt holders. So this is what I want to see quickly in our case study. And what I do here is I consider now the case that the firm has, so now the firm has 400 of leverage. And if the firm has 400 of leverage, it means that the value of equity will be 600 because the value of the firm is still the same. The firm value does not change. Okay, the firm value is still 10,000. So let's look at what's going on here. Okay, the case of the risky debt. So if the debt generates a regular annual payment of 5, so here I consider what? I don't provide the model, but I say that this new leverage here is paying out a coupon every year of 550. Okay, so what you pay here on the debt is 550. So you can see that the yield is higher. You used to pay here 500 for 500. So the yield was 10%. Here you pay more than 10%. Okay, so what is happening is that what will happen in terms of flow? Well, look at that. Interesting. Bad state, good state. Good state, 1,500. Bad state, 500. And now we look at the way this is split between shareholders and debt holders. Debt holders will receive, so if you are in good state, debt holder receive 550. And then 500 minus 550, 950. Shareholders will receive 950. And when you are in good state, okay, when you are, I'm mistaken here, so this is good, so I have to change that, this is bad, okay? So if you are in bad state, okay, what does it mean? Well, it means that you are defaulting. And when you default, it depends on bankruptcy laws. And we imagine that there is absolute priority of the debt holders, meaning that as long as there is some money and you don't pay the debt, nothing goes to shareholders. But there is limited liability of the shareholders. That is to say, shareholders do not have to pay on their personal money the debt holders. So what does it mean? It means that the 500 goes in the pocket of debt holders. But they don't receive more than that because they cannot receive more than the flow of the firm. and shareholders receive 0. So now, if you look at that, that's very interesting. You still have minus 1,000. This is the loss, but this loss is going to be split between the shareholders. Shareholders do 9,500, and debt holders, they lose 50. So what you can see is that the loss is shared. 95% of the loss are the shareholders, 5% of the loss are the bondholders. So there is a split. The loss of 1,000 now is split between the shareholders and the bond. I'm back. Sorry. Let's block that. Okay, I'm going to just remove the sound. So what you see is exactly what I said before, is why is it, okay, so why is it when you increase, okay, if I go back to my picture here, when you increase the leverage and the debt is risk-free, the increase in risk for shareholder is maximum. But when the debt becomes risky, because you share the operating risk with debt holders, so debt holders here are taking their share of the risk, it means that K will increase, but will increase less. And this is very difficult to understand for professionals. Okay, and that's a problem because it means that we have understanding of leverage and the way leverage affects risk and return, which are wrong. But this is the correct way it is affecting that. Okay, meaning that you have a certain asset with a certain level of risk, you create a risk-free asset, you increase the risk for the equity holders. And then if you have a certain level of leverage that it turns to be risky, it means that you share the risk, that the risk is shared between those guys, the debt holders and the shareholders. And then it means that the marginal risk of equity holders is increasing, but is increasing less fast. And I think this is very important for you to understand. So now the sole thing I do between slide number 68 and 69 is just I divide here, okay, by 4,600. I divide here by 5,400, okay, and here I divide by 5,400. Okay, so I just divide that by the value in order to have the return. Okay, so good and bad is okay. Okay, and what I have is 20, 65, 0, 10, 18, and 9, 26. So what you see here is that now there is volatility. So there is some volatility of return here. You have volatility, of course, for here the equity, but you have some volatility. By the way, this is the yield to maturity. So this would be the yield to maturity. Remember, the bond yield, the yield to maturity is the return that you get if there is no default. Okay, so here there is no default, and this is what you get. And what would be KD? Well, KD would be the expected return. So in order to KD, I should have here a probability. So I should have a PD, a probability of default, and 1 minus PD. Okay, so if I add here a certain probability, multiplied by that, probability multiplied by that, I would have KD. So KD, the expected return, is the probability and the return in case of default multiplied plus 1 minus PD multiplied by the return in case of no default. Okay, and what you see, and I want to really highlight that, a couple of things I want to say here, is you have 0 and 20, 65, and here, sorry, not go too quick, this is not that easy. So here you have 5% and 15%, and then you leverage the firm, this is N, and this is L, and you have 0 and 20%, and then what you have is 0 and 20, 65%. And what you observe is that, of course, because of limited liability, because debt holders, because equity holders don't pay more than what's in the firm, okay, there is a cap on the losses for the shareholders. or shareholders have minimum, they cannot lose more than what they had in the firm. Here I just compute as a flow, but I could say, okay, I lose everything I invested in the company. And what you observe is that the return here is increasing, but here the volatility is increasing, but increasing less because a share of the risk is transferred to the debt holders. Okay, so out of the operating income and the operating risk, you create risk for equity holders, risk for debt holders. Debt is risky. Okay, so last thing maybe I want to see on that, and I think it's going to be time, and I don't want to overrush. The rest is easy, and this is the most difficult part to address. I want to discuss just about beta. Okay, what would be beta of equity? Beta of equity would be covariance, return of the stock, RM, variance, RM. Okay, and it's going to be correlation coefficient, sigma stock over sigma market. Okay, so this is the beta of the stock. Okay, and so if I want my beta to be different than 0, so here I have some volatility. Okay, so in order for beta different from 0, I have to have this different from 0. Okay, so if the correlation of the stock of the return with the market is different from 0, then the beta is different from 0. But what will happen then? Well, what will happen then is the beta of the debt is different than 0. Okay, so what we observe is that if you have some volatility on the stock return, okay, and what creates the risk here is correlated to the market. There is some correlation of this risk with the market, and if this risk therefore is also correlated to the market, so it means that if there is a beta of equity, there is a beta of the debt. Okay, so meaning that rho dm sigma d over sigma m, and this will be different than 0. Okay, in this simple example, okay, if beta debt equals 0, beta debt equals 0 only if the beta of equity is equal to 0. Because what triggers the risk for the equity is also what triggers the risk for the debt. So the risk comes from the bad state, and if the bad state is correlated to the market, the bad state is correlated to the market for the debt as well, and the beta of the debt is different from 0. Okay, so I just draw your attention on that. This is important. In the case study I will give you, you will have to look for the value of the debt, the cost of the debt, the bond yield, the beta of the debt. So all this you will have to discover. And you will do that exactly as we did for pharma. And you will really improve looking at all that and understanding all that. Okay? And maybe just to summarize, you have firm value, you have a capital structure, so you can have senior, junior, you can have convertible, you can have whatever you want. Okay? What Modigliani Miller tell you is that you split the cash flow, you create risk and return, that are different. You create claims with different risk and return, okay, and those claims work like that, okay. Is here you have increased priority, and the other side you have increasing risk and increasing return, okay. And the way you split, okay, the way you split the cash flow does not affect the firm value as long as free cash flows are not changed. Okay, so if the way you split the cash flow does not change the free cash flow because there is no taxes, because there's no incentive, because you don't change the investment of the firm, because you doesn't change the governance of the firm, etc., then we do not expect any change in value from splitting differently the cash flow of the firm. And to finish with that is really, when I say, I want you to keep that in mind. Capital asset pricing model applied to asset side. Modigliani Miller applied to liability side. Is really very important. It's like physics. Okay, it's like something that you cannot discuss. Okay, is like that. And it's very important when you look at any kind of operation. Okay, remember Carrefour, I have some real estate, I have operating asset, I remove that. Okay, then this goes out, then I have some rents, I have some initial equity, initial debt, and then this real estate is going to shareholders. Huh? Okay, you can really apply capital asset pricing model, you can really apply Modigliani Miller to look at that. That is to say, be able to understand how the risk is changing, how the risk is changed, how the risk is changed, how the value is transferred between one or the other. And what you really have to understand is really that on the asset side, it's a combination of assets, and with Modigliani Miller, the KE, KD, etc., all the relationship, all this can be used to know exactly what's going on. And the case study I will hand you is to train you to make reasoning using that. And there are too many mistakes with people doing reasoning that are a little bit poor, using multiples, not being aware, do not pay enough attention to the level of risk, etc. So we have to see that. So maybe you can look at that. It's really simple. You have the solution, so I will not go into that. And yes, and just I want to leave you with that. It's late, so maybe I'm not sure that you have been working on that, but maybe over the weekend for Monday, okay, maybe I would like you to try to think about that. That's easy. This gentleman is Franco Modigliani, and this is a case study, but this case study is based on a very, it's a 2-line in the Modigliani Miller article. And then I built a small case study and a larger case study, and you're going to see that it's something really to learn about correctly reasoning. A friend of mine who is a CFO of a large company here in France, and I've been sharing with a lot of training with him for executive in firm, he said, everybody working in finance, so you are all more or less working in finance, should be able to do that. If you're not able to do that, meaning you do not understand finance, and there is a problem. It's like a little bit like a doctor, you know, if you are unable to whatever, be able to detect that someone is sick because he has a heart problem, or when you listen to his heart, then you should not be a doctor. Well, someone that is not able to do that shouldn't be a guy working in finance. So that's a nice case study. It's 10 p.m., so it's time to take a rest for you. I think that we won't do that tomorrow. We will do that Monday, so that you have time over the weekend, and that's the best thing you can do. I will upload pharma answers. I will upload some exercise and solutions so that there is more food to think about that. I will upload the case study, maybe not this weekend, I will see, but next, we still have time, because other courses are in 2 weeks. But you have to work, obviously, a little bit to progress. And we'll discuss that in 30 minutes tomorrow before going to, so tomorrow I'll go through that. It's easy, you know that, but I'm going to show you where it comes from. We'll discuss in 15 minutes dividend policy. Just make sure that you understand well dividend policy, and then we turn to options. So we are 30 minutes late, but that's okay. Any question before I leave you? Before I say you bye for the evening? So I hope the room is correct, the sound is correct. At least you can see the screen. You cannot see me really very big. But I have forgotten my tablet, so I would prefer to be in my office, but and I was unable to find another one. We have supply chain problem, and some goods are not coming now. I guess in Vietnam you have the same issues. This is the new life. Okay, so if there is no comment so far, and thank you so much being trying with camera open. It's really nice to have you. Huh? And so thank you very much. See you tomorrow. Okay? And come up with questions. Huh? As many questions as we want. If you need to rethink about things, if you need to discuss again some things, I'm open. But you'll see that it will with exercise, case study, etc. It will come. But the goal is for you to become better at the end of this course and be more, as I say, be advanced is be good on the basics is what's important. Huh? It's not to learn more details, it's to be stronger. Huh? To be stronger to address a case study. You know, when you know how to compute a free cash flow, when you understand that creating value is about marginal free cash flow, and if you're able to tackle correctly discount factors, understanding risk return correctly, capital structure, composition of assets, then you're good in corporate finance. If you don't understand that, you cannot be good. Okay? Okay. Have a good night. Huh? Bye-bye. Bye, you all.